Hi, I wanted to do a real quick video on what happened today on talking with Tom and Tony this morning. I think I was the third or fourth caller, I'm not too sure. But anyway, I wanted to do a real quick video on how you can actually apply this to your daily ritual or your daily regimen on placing trades or looking for trades. I know a lot of you do not have a lot of time to, you guys work full time, you can't sit in front of a monitor all day. So how can you manage your own money with a high probability of success? So basically, this was regarding yesterday's July 17th market measure on entry, where to place an order for ETFs. That way you don't have to worry about dividends or earnings and all that other stuff. So I thought I'd do a real quick tutorial on, especially for new people, and this forum was basically started to help new people get up and going, because once you get up and going, you probably won't visit here too much. Maybe you'll be checking out the more advanced stuff, but you need to know the basics and the foundation, and I believe that this is going to be your benchmark, meaning if you want to know if you're trading well, you need to compare how you would have done had you have just done this strategy day in and day out. Okay, so let's just get started. The crux of the golden gecko is, and I'll display it start to finish from for new people here. The crux of the golden gecko is selling a put and a call, one standard deviation out of the money, and also buying the put and the call, two standard deviations out of the money, which basically gives you a 68% chance of being right, because each leg gives you 84% chance of being right. So let me just visualize that for you. It's a lot easier. It's more important you know what to do than why it works. It's almost better just knowing that it works and just being mechanical and doing it. So here's what your daily routine would be. You'd click onto Dole, right? And here's your home page that you're going to start off with. You're going to go to your grid, click on the grid icon. You're going to select from this drop down menu notable stocks. You're going to go to this filter, click on the filter, click on hide earnings, slide this slider to 35% or 35. This is your IV rank. Probably one of the most important things you need to know is right here. Click on the filter again to hide it. Click on volatility so that the arrow is pointing down. What this will show you is these are all their notable stocks that are in with high IV rank 35 or greater with no earnings, routed in descending order. Now, usually we talk about your IV rank should be 50% or greater. That's true for individual stocks. With this study, they did ETFs with a IV rank of 35% or greater. So, which is why IWM is highlighted, because that's the exact same ETF we talked about today on Tom and Tony. So basically, the formula is, if you have an ETF with an IV rank of 35 or greater, and you can sell a golden gecko or a strangle and collect 19.8% of its expected move, you have a very high probability of making a profit. Okay? So how do you know if we already know here's IDM, it's an ETF, and here's your IV rank. You already know it's 39%, which is higher than 35. So can we place a trade? Well, let's find out. What you want to do is you want to double click on this icon and it'll open up your trade page. Okay, I'm going to let it load, see if folks all can see. And remember now, this is all geared for new people, so if you're older, you've been here too long, just bear with us. It's just, we got to help everyone out. You click choose strategy, and you're going to click on strangle. When you click on strangle, you want to make sure you want to click on short strangle, and that star is the default for the short strangle. That way you don't have to keep on doing this over and over again. Click on show advanced. You want to make sure this is 45 days to expiration. You want to click monthlies, and you're going to click on one standard deviation out of the money. Okay, so I click on that, and Dole says go. You hit go. Okay, and here's your strangle. All a strangle is the green anywhere you make money. So if IWM stays within this price range, you make money. So basically what you're doing is you're selling a put at the $108 strike. All that means is it's just fancy words for saying, hey, you're betting that IWM is going to stay above $108. You're also selling a call. A call is basically the opposite of selling a put. You're betting that IWM will stay below $121. Okay? And how much you're going to collect? Somebody's going to actually pay you for this. Okay, so you're going to collect money up front. How much you're going to collect? 79 cents per contract. Each contract is 100 shares, so you multiply that by 2 or move it to small towards that. $79 is what you're going to collect. Okay? Now, is that enough? Is that 19.8% of the expected move? How would you know? This is why it's important that you know how to use toss as well as dough. So you're going to go to your Thinkorswim. Okay? You're going to, here's my chart. Type in IWM. Okay? Doesn't really matter if you have this chart or not because I'll show you why in a bit. IWM will load, right? You're going to click on the trade tab right there, and this is what's called your option chain. What you want to do is you want to look for the same option chain that was on Dole. So you have August 14 and there's 28 days to expiration. This 100 just means that there are 100 contracts per 100 shares per contract. Okay, that's all it is. Now, how do you know it's the same one as Dole? Well, I'll go back to Dole and take a look. Here's August 2014, and you have 28 days to expiration. All right. Back to the option chain. What is the implied volatility? The implied volatility, not the IV rank, the implied volatility is 19.25%, which means the expected move for IWM for the next 28 days is plus or minus $4.93 or $4.94 if you round up, which means based on this implied volatility, IBM's price here should fluctuate between plus or minus $4.94. So the market measure said you need to collect at least 19.8% of this. Okay, so I'm going to go back to Dole and let's find out what that is. You can use any kind of calculator and you can punch in $4.93 and you want to multiply that by 19.8% or 0.918. That means we need to collect at least 97 cents to make this fit the parameters. How much are we collecting? See down here? 79 cents. We're not even close. So now you know you can't place this trade. Now if you were closer, you could adjust the strikes and you could come over here and add and try collecting up, and if your order gets filled, you're good to go. Now what Tom was saying is, what I asked Tom was, well, if you're in an IRA or you don't want that much money at risk, okay, because this is a naked put, this is what's called a naked put and a naked call, because you're not buying anything to offset it. Okay, so technically you have unlimited risk and the most you can make is $79. Now what a golden gecko is when you buy the 2 standard deviation out of the money puts and calls. Okay, now so what Tom was saying is, hey, if this number on the, you go based on the triangle, if this number is correct and it's over that 19.8%, go ahead and you can do a golden gecko, basically a big wide iron condor, and just take whatever you're going to use the credit that you receive when you do that. So what do? Once you know you have enough here, in this case it's not, but let's say it was, all you do is just go to choose strategy, go to iron condor, make sure normal iron condor has a star as the default. Okay, your advanced setting tab might be like this, so click it back out, make sure this is 45 days, 84, click on 1 standard deviation, which is 84% out of the money, and you're going to click go. And now look what happens. So you still have the wide strikes down here at the 1 standard deviation line, but now you're buying the outer ones, and you want to slide these out so they're at the 2 standard deviation line. See this gray dotted line? That's the 2 standard deviation out the money line. You want to slide these out so they're right there, and whatever that credit is, you can fill it. Okay, so that's basically the same thing. And remember now, that market measure was done and they held it to expiration. Okay, now you earlier today you could almost get this filled. In fact, but of course there's not enough credit today. But earlier in the day I tried. I mean, here's my activity here. I'm trying to get it filled, but see, it's too far away. Okay, so back to the grid page. Now that's for an ETF. What about a stock? Okay, how do you know if this will work on a stock? Well, on a stock, you want your IV rank to be at least 50% or greater. Well, look at WAG, Walgreens. How do you know if you should place a trade, or if it's safe, or if you have a high enough probability to profit, or if you can collect enough premium? Well, what do? You double click on WAG, okay, and I already have a position here, but I'm going to just walk you through it anyway. And repetition is the mother of learning, so let's walk through this again. Let's see how much premium you collect if you just do a 1 standard deviation strangle. Click on choose strategies, click on strangle. See, it'll memorize everything you did the last time. Click on go, and here it is. You're going to be collecting $1.02. Is that enough? Well, what do? Let's go to Thinkorswim, type in WAG, W-A-G, hit enter. Let's go to the same option chain month as that it was in Doe. Well, let's double check. August, 28 days to expiration. Go back to Thinkorswim. August, slide across. Oh, 28 days to expiration. So slide across. The expected move is plus or minus $5.69. So we know we have to collect at least 19.8% of that. So $5.69. Let's find out. Okay. $5.69 times that by 0.98, 19.8% equals, we need to collect at least $1.12. Where are we? Not quite. We're only going to collect $1.02, right? So we're about 10 cents short. Now, if you don't have an IRA and you want to try and make this work, right? You want to try and make this work, well, place an order in for 10 cents more. Click on this until it gets to $1.12. Click on review and send it. And if your order gets filled, and you know it worked, right? Now, if you have an IRA, like this account is not, my account is an IRA that I've been using for this project because I wanted to use an account that everybody could copy me and trade with. Well, you know I'm 10 cents short, right? So you can't do this in an IRA because these are what's called a naked put and a call. So I go back, I go choose strategy, I go to Iron Condor, right? Everything we memorize, here we go, right? Everything's the same. Click on go. And remember now I was about, what, 10 cents short, right? So I want to make sure my strikes are about right. Move this out if I can, if it'll let me, but if that's as wide as it can go, then that's okay. Oh, that one, let me just minimize this a little bit. Okay, here, so I want to bring this in if I can. Nope. That's the closest one I can do to on the money. Same thing. Alright, so here's the same thing, but reducing your risk by buying the 2 standard deviation out of the money puts and calls. Okay, well, it's way past that, but that's okay. Now, but remember now I'm short, so how much should I try and collect? I was about 10 cents short the last time on a strangle, so I want to collect at least maybe at minimum half that. So I want to collect at least 5 cents more. I can try up this 5 cents. I can try to do 10 cents, but you know, which would be $1.03. Doubt if I'll get filled, but you can try at least 5 cents higher, right? And then go ahead and click review and send, and then place your order. And if you get filled, you're pretty much following the same market measure, and that's all you do day in and day out. Okay, so if you have 15-20 minutes a day to do, it'll be perfect, you know, for you. If you don't want to worry about earning, oh, by the way, that's why I like to use Thinkorswim as well for individual stocks. For example, I know we clicked on hide earnings, but sometimes if you look on Thinkorswim, you're gonna see that it expires right before earnings. All right, so if you look, let's pick a stock. Okay, good. Let's pick CRM, for example, right? Let's go to Thinkorswim, type in CRM, go to your charts page, and if you look, okay, look, here's a good example right here. See, if you had sold Golden Gecko, and it expires, in May. Earnings was like the day after.